Maximum funded index insurance contract. What is this? How IUL can use small businesses, people who just came to United States and opened their LLC, S corporation, C corporation, or maybe people who live along in the US and they have very solid business, how they can use indexing strategies. Today we're going to discuss with Brian. Hello, Brian.
Hello, Elvira. Thanks for having me.
And let's start with, can you introduce yourself and say why people should listen you?
Yeah, so my name is Brian Jarrell. My tagline on most social medias you'll find is IUL with Jarrell. I have an extreme passion for the product. I've studied it pretty hard for the last 4 years. I've enrolled in multiple courses, read many books, ran a bunch of spreadsheets. I know the product pretty much inside and out. And I'm just here to kind of clarify a lot of the misconceptions and stuff like that behind the IUL so people can get a better understanding of how it actually works versus all the stuff that you read on the internet.
Tax-free accumulation, tax-free access. You can put any amount of money. You can take this money anytime you want. If you're not going to spend all money during all your lifetime, you can pass to your kids or grandkids to next generation tax-free. So all those describe IUL, and for many people, it's a product very attractive, or this concept, let's say, it's very attractive. So let's talk today about problems small businesses facing today and how they can solve their problems by using IUL.
Yeah, absolutely. One of the biggest things that people don't realize is when you have a key person, whether it's a key manager, a key employee, or something like that, when they leave, you got to replace them. That's not free. You got to go out there and go on a hiring spree. You got to find the right person, interview multiple people. You got to take yourself out of the equation of what you were doing to be able to do this. So a lot of people just don't realize how valuable that is. And that's, one component that we use is what's referred to as key man insurance. So that way, if you did have like a key manager that passed away, you can basically inherit that death benefit to kind of, absorb some of that cost of having to replace them as well. So that's one way. Another way is very similar to like how Disneyland and JCPenney and Macy's and, Ray Kroc used with the McDonald's ice cream machine is you can leverage the cash value to be able to, finance more machinery or new projects or whatever. So, there's been several different ways that it can really benefit from companies and sort like that. Another cool thing is, for certain like retirement stuff, there's something called the golden handcuffs as well, where let's say that you do have that key person that you don't want to lose. You can offer them, a retirement where you put away X amount of money for them. And now if they stay with you for 5 to 7 years, they get paid out that cash value. If they don't stay with you, well, then the company gets to inherit it as a tier one asset. So, there's kind of win-win situations like that where those are just a few of the different ways that you could use it for small businesses.
Like I meet in every day a lot of people, and I meet, of course, some small business owners. And what I see the situation in particular Russian-speaking community, people who came here from former Soviet Union, very often I can see that they have LLC or they have their own business, small business, but their family, their wife and kids, they stay home. So basically, they have only one source of income. So can you explain how IUL can protect or can help family with one source of income in this case?
Yeah, absolutely. One of the nicest things about these type of policies is they do have what's referred to as living benefits. So, as you're still alive, if you were to suffer like a heart attack, stroke, cancer, brain aneurysm, tumor, anything like that, these companies allow you to access anywhere between 50 to 100% of your total death benefits. So that way, you don't have to lose your income while you're out because, you did have a heart attack or, something like that. So, that's an amazing thing that these policies can do is help relieve that burden.
Yeah. But a second problem, what I see, of course, everyone, they won't cut their taxes legal way, I believe. But of course, nobody don't want to pay more taxes. And what I see most of the time happened when CPA suggests to small business owners to open IRA account, to, do tax deductions, right? Reduce their taxes. So I want to know your opinion about all these things. So in which cases it will really help and works, and when you need to be like careful, or like, and again, how like IUL can help small business owners in this case.
Yeah, absolutely. Tax avoidance is okay. Tax evasion is not. So first and foremost, I am not a CPA. So anything I'm giving is not a recommendation or advice, but it is education. At the end of the day, what CPAs are trying to do is they focus more on today than what they are tomorrow. So yes, they may tell you, hey, you need as many deductions as possible because they want it to look good because they're lowering your bottom line in total taxes today. But often what they do is they set people up for what's referred to as a tax trap. See, if you're taking a standard deduction because you contributed to like an IRA or a 401k, all it's doing is lowering your income. So if that deduction doesn't physically take you into another tax bracket, really all you're doing is procrastinating that tax to a future rate. If you feel like taxes are going to be higher in the future than what they are now, it's kind of like, why do you want to procrastinate? So you got to be careful. Again, these CPAs are doing their job. Their job is to save you taxes today. They're not doing planning and prepping for the future. So just make sure you're doing your due diligence and figuring out if you are setting yourself up for a tax trap or something like that as well.
So third problem, what I can see with small business owners, they don't have like, stable income. Let's say their company can make profit like this year, like let's say like 20,000 or 50,000 next year, then following like 10,000, or maybe it can be like 100,000, 80,000, it's maybe 20, maybe nothing. We just not a long time ago facing this COVID things happen. And we know a lot of small businesses been closing. So we understand what is business. It's not stable. So how they can use this IUL in this case, and because they ask me a lot of questions about premium. So if I don't have a stable income, so how I can set up this account properly, and how I need like put this money, so what I need to do. So how are you going to answer those people?
Yeah, so the IUL, the premiums are flexible, but just because they're flexible doesn't mean that you could just put whatever you want. You got to make sure that when you're building these, you kind of want to get an average of what it is, but there's nothing wrong if, we build it for 20,000 a year, you put 20 in the first year, and then all of a sudden, business slows down, you can only put 10 the following year. It's okay, because what it does now is it allows you to put in 30,000 in year 3 to kind of catch that back up. So it is fairly flexible. And the nice part is you're going to have that cash accumulating. So if you do have a bad year and you need to draw some out of the policy to be able to kind of make ends meet for that period, it's a great versatile product in that particular aspect.
Fourth problem, what I can see, like most business owners, of course, they want grow their capital. They want save and grow their money. Nobody don't want to lose. So how do you think this maximum funded index insurance contract can help them to save and grow their money?
Yeah, I think one of the most underutilized things about the Index Universal Life Insurance contracts are the fact that let's say that you have $100,000 of cash value and you need to pull 50,000 out to buy new machinery or to hire a new person or something like that, you're still compounding interest on the full 100,000. So your capital's still working for you. So that way you can get those machines to start bringing in more money. So that way you can use that to pay back the loan on the policy as well. There's nothing like using it kind of as like the laser banking style for these policies, because again, you're earning interest on money that's not even there. And that's something I think that is heavily undervalued in these types of products.
Yeah, what is laser banking you just mentioned?
Yeah, what laser banking is, we'll use real estate, for example. Let's say that you have a piece of house that you come across and it's $100,000, it's a fixer upper. You can pull that $100,000 out of your cash value life insurance, pay the house off, use the money to fix it up, do whatever you need to do. And then let's say, a year down the road, you flip that house for $150,000. What you're able to do now is take that original $100,000, pay it back to the policy, and now you're back to square even on that. And now you got the extra $50,000 of profit that you're able to, basically utilize your policy as a bank. You become your own bank instead of having to rely upon a bank. So guess what? If business isn't booming that year and you can't get qualified for a loan, you don't have to be concerned with that. The insurance companies are going to give you the money because it's your money.
And I have several questions people ask me, so I would like to address those questions to you. a lot of times I can hear, oh, it's too be good to be true. Wow, it's so amazing. Like you saying about all these things. So you can have like a market loss, like protection. You have tax-free income. You have such a, like you just mentioned, a lot of good things about IUL. But what is the downside of this, or what risks behind of the scene?
Yeah, one of the biggest downsides is, unfortunately, you're at the agent's mercy. I can't tell you, Elvira, I've done over 400 policy audits, and out of those 400, I've only come across 12 done right. You got to remember, when cash is our goal, we really don't want to get life insurance. We want to get the smallest amount the IRS physically forces us to get. Well, by doing that, the agent is taking a major hit to their compensation. So not many agents are doing the proper thing. Again, out of all the audits I've come across 12 done correctly. So that means 97% of the policies out there are not done correctly. So it is very important that if you do have a cash value life insurance policy, you do make sure you get it audited by somebody who knows what they're doing.
Can you tell me about 401k for small businesses? So I know some people, they like set up LLC, let's say, so, and they hire employees and they like to open this 401k to their employees. So what benefits they can have, and can we compare this to IUL and maybe suggest to those people not open 401k and just do IUL for themselves, for their employer?
Yeah, so whenever it comes down to it, you got to look. There's four major pillars to any financial vehicle. You got liquidity. Do I have access to the money? You got safety. Is it safe, or is it subject to market volatility? You got rate of return. Is it pacing with inflation? And then we have tax advantage. So if we look at like a traditional 401k plan, again, most of the time, folks, when you enter into a 401k, yes, you're able to deduct that. But again, if it doesn't take you into another tax bracket, all you're doing is procrastinating taxes. So let's take a look at the liquidity. Heaven forbid you need that cash for a capital investment, for healthcare, for whatever may come your way. If you need that cash from a 401k, you can take a loan. But if you don't pay that loan back within 3 years, guess what? You incur taxes and penalty. You look at, so as far as liquidity, we'll give it half a point there. We look at safety. Is a 401k safe? Absolutely not. We saw the 401ks absolutely bottom out in 2008, where people lost 40% of their portfolio. To put that in perspective, folks, if you put up a nest egg of $500,000 and you lose 40%, you lose $200,000. You're down to $300,000. That's not going to allow you to retire. You're going to be working for another 5 to 7 years. So as far as safety, I'm going to give it a 0 on that. Now, we look at rate of return. Yes, the 401k over a long historical period should be averaging between 6 to 12%, depending on how well it's managed. So as far as rate of return, I would say it's pretty comparable with the IUL. Now, we look at tax advantage. Again, just because you're taking a deduction today doesn't mean you're not setting yourself up for a future tax trap. So because of that, I'm giving about a half a point. So on a scale of 1 to 4, I would give the 401k a 2. Now, we take a look at something like the Index Universal Life Insurance contract. Is it liquid? Yes. If it's properly funded and properly structured, you can have access anywhere between 40 to 80% of your cash value year one. So is it liquid? Absolutely. You don't have to pay it back if you don't want to. If you end up not paying it back, they just take the loan plus the interest from the death benefit. So 1 point on liquidity. Is it safe? 0's the hero, folks. You can't lose any money. So I'm going to give that a 1. Absolutely safe. And we have returns up to 61% in a single year as well. So rate of return, again, it's very similar to like the stock market with the S&P 500. So you're going to average anywhere between 6 to 12%, depending on how well you're managing those crediting allocations. Is it tax advantage? Absolutely, folks. Remember, using a tax code 72E 101A and 7702, you're able to access that money 100% tax free. So if you throw 100 grand in and it grows to 400 grand, there is no taxes on the additional 300 that you've accrued.
Then people said, okay, I already have financial advisor and he never told me about IUL. Or sometimes they said, yeah, I talked to my financial advisor and I had this one situation when person said, business owner, he told me, I asked my financial advisor about this strategy, about IUL, and he answered me, just don't. And I said, okay, what does that mean? And he said, I have him 25 years. I trust him. So any explanation, why don't? What's going to happen, like if he will open this account? And, so how you can and what you can say to those people, who already have financial advisors, and if they authority, people who they trust, they said, okay, don't do it, it's something not good.
Absolutely. Some of the craziest embezzlers of this world have been financial advisors that are 10, 20, 30 years. So I always tell people, listen, it never hurts to get a second look, period. I've always offered, hey, I'm willing to jump on the line with your financial advisor. You can hear his side, you can hear my side, and then you can formulate your own opinion. So that's kind of how I take it. Listen, I have your best interest at heart. If your financial advisor has the best interest, your best interest at heart, he wouldn't mind both sides discussing it, so that way we can come up with the best plan for the client instead of for him or for me.
What I see sometimes happen with business owners, so they take short period of time, so they take in first, like, let's say 3 years, and they try count, and they see, oh, it's like take a lot of fee and charges from first years. But how we can help them understand that it's this first phase, like first 10 years period, it's not much important than like distribution period. Then they can have a lifetime tax-free income, like rest of their life. And so what you can say to those people who's focusing, on the beginning, not like to the results, what they can get from this policy?
Yeah, absolutely. David took out Goliath with a slingshot. What do you have to do with a slingshot? You got to pull it back to shoot it forward with momentum. If anybody's ever been hunting, what do you do with the drawstring? When you grab a bow, you pull it back to shoot it forward at an extremely high speed. So yes, sometimes there are fees, and it is going to set us back for maybe a year, 2 years, 3 years. But then what it does, it allows us to project forward. When it comes to any financial vehicle, so many people are so worried about the accumulation phase that they forget about distribution. Remember, you can earn all the money you want in the world, but if it doesn't ever pay out, it doesn't really do the job, does it? So again, don't focus just strictly on accumulation. You want to look at the distribution phase as well. One of the strongest parts about the IUL is, as before mentioned, if you got the money in there and you start pulling it out for income, you're still earning interest in the full principal, uninterrupted compounding growth.
And let me ask you the final question, what I received like recently. Can you provide illustration of how the policy might perform under different market scenarios?
Absolutely. Everything is going to be on a case-by-case basis. So, for something like this, you definitely want to get set up with the right person. So what I recommend is go ahead and click the link below, so that way you can get with the right person to make sure that it's done the right way.
Okay, thank you very much. And I hope I see you soon and we can continue conversation about IUL.
All right. Thanks again for having me on, Elvira.